Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. I'm Rapstein, and here we are on Friday. And, yep, this is the 6th of January, 2012. I just got back from vacation, as you know. First day in the office was yesterday. Still catching myself up, doing TV interviews. I hope you saw me on Bloomberg today. I'll be on First Business on Monday morning, and Bloomberg again come Monday afternoon. CNBC's coming up as well. But, you know, the one thing that everybody's trying to do is get their handle on what do you do this year? What's the year going to be like? You know, any way the traders want to cut it. The stock market didn't perform very well. If you take dividends into account, you probably were ahead, not behind on your market year-to-year basis if you had all the S&P 500 or the Dow stocks. But you really didn't go too far one way or the other. Traders are already saying they don't expect a lot of the stock market this year, and I don't know that I'm agreeing with that. A lot's going to depend on Europe. Does Europe get behind, or stay behind is the better word, the curve ball, or are they going to get ahead of it? I think at some point they've got to get ahead of this problem that they have. You're hearing about Hungary already. You're going to see next week more talk about Spain and Italy, what's going on there. So it's not good. Is the euro going to come apart? Sarkozy was speaking today, and he was saying, he thinks that's the end of it if the euro doesn't stay, that there'll be, if you will, trade wars, all these other things coming on. At least that's how I interpreted his statements, and I'm not buying into that at all just yet. But if you get problems in Europe, it's hard for America to grow forward. The gold market, when you look at the bigger picture, the market's still in somewhat of a downtrend. It probably got too cheap at year end. A lot of selling, people just balancing books. It's come back up, and it's fighting a battle where I'm not surprised in the 1620 level, which is where we closed July 31st. I'll keep mentioning that just because I found it interesting. In fact, I'm going to end the week up. At first, I said I'd take it off the chart. I don't want to yet. This is the number that I thought we'd close at or higher for the year. It's amazing how we stayed down and immediately raced back up in the first week of trading and stalled out against that number. That's all that I'm saying. I think the game from this point on starts looking to see what is going on, and the chart picture is not clear. What the chart picture has done is run straight up from 1523.90 to a high today of 1632.30. It's a $110 an ounce run-up. So if you were to buy into this on any normal correction, you've got a problem. Where do you put a stop? And that, to me, is the biggest issue of this market. Where would you put it? I'm going to look for the market to try to play around this 18-day average of closes. And one of the rules that I give you is that markets that are under these averages, you're looking for potential sell signals. Markets that are over it, you're looking for potential buy signals. Right now, the swing line is up. Got a higher high than 1615.60, and you're over the 18-day average. The dilemma is, where do you put the stop? If you were to buy at 1603.10, do you really want to risk about $80 in the market? I don't think so. I'm not interested in telling you to do that. Longer term, and I use the word longer term, I see lots of resistance above the market. You know, one of the things markets do is they distribute themselves in funny ways. I think you'd agree that there was a lot of trading up here, and then all of that gave way, and the chart collapsed. We're now getting a bounce, but there's still levels of average resistance, and that's the 45-day and the 100-day that show you where that is. So, yes, I want to go on record. I'm a gold bull. I'm a long-term gold bull that thinks that gold is a runaway market at the end of the day. Why? I think two things. Number one, I believe that we will all print money. That's all of us, Europe, China, America, whoever has to do it in time to keep their economies going. That's been going on in America. Europe better start looking at what we're doing and do the same darn thing. It's working pretty good right now for us, isn't it? QE3, Is it going to be one? You know, right now I table that. I'm not saying no, you don't keep that ready because psychology is so much of the market, but it's not ready. So if Europe weren't on the horizon and things were doing just as we're doing, don't you think there'd be an inflation story? We're not there yet, but don't you think there'd be? Now let's assume Europe goes sour, which I don't think there's a what if. I think it's a question of how low the euro goes. And I'm not saying the euro goes straight down from 140s down to the 120 level. It works its way down, but I think there's lower prices coming in the euro. I don't think this European situation's going away, and that's what I think gold is pricing in on the chart. The black lines represent Bollinger Bands. Markets rarely stay over or above a Bollinger Band. And what they're doing now, these black bands, is they're narrowing in. This market's going to develop in the early part of the year, in my opinion, a trading range, and more normal type trading is going to set in. I consider this the year end, whatever you did, taking profits, people getting out frustrated, I don't care what it was. I now think the market's going to get back over the next week or two into more normal footing in that market. When I look at the stochastic study, you're in an overbought condition. You've got a reading of 72 right here on that stochastic. 72 readings are not what I consider you buy into the market. That's an overbought rating. So gold, to me, table the idea. I don't see a lot to do there. Silver's already doing what I expected it to do. It's playing against this 18-day average. The stochastic at 29.74 took out this high. So you have a pattern so far, at least, of a high that is higher than a previous high. We don't know where this low is going to end up, but if it were to develop down in this range between 28 and today's low, 28.57, and then take out today's high of 29.46, I could get actually quite bullish on the market. Until that occurs, you're under the 18-day average. There's nothing to do. I think you wait. Another market that I'm very friendly on long-term is copper. Now, I'm the first to tell you the problem for copper is Europe. You take out 338.45, you might fall to the 325 level. But what I think is the $3 level is a bottom in this market, an important one. And I think anything between there and this general area is where the market's going to find its next real good trading range. Some might argue already that it's developed it, and in terms of maturity of a Bollinger Band pulling in, unlike it did in the gold market, I'll bring you right back there. Notice how the gold's narrowing in right now, silver's narrowing in. Well, you're already there in the copper. This market's a better looking chart than all the other charts in terms of, I think it's getting ready to set up a trend. Take out 338.45, I think it'll drop back to 327 or so. Keep the market above that number. I think it's going to find support around 340 and try to work its way to 353. I give the bulls the bias until 338.45 is taken out. In the platinum market, all that I was looking for when you lost your embedded stochastic was a challenge of the 18-day average of closes. It did it 2 days ago, and since then it's just been working sideways, and the market hasn't stayed over that 18-day average. So I consider this chart pretty darn neutral. In the natural gas market, I know that so many people are dying to belong this natural gas, and frankly, when you lost the embedded stochastic here, it threw out a signal that I'll stick my neck out on, that it's going to challenge this 18-day average of closes. Now that number's going to fall a little each day. It's 313.50 right now, and the reason I know it's going to fall is 18 days ago you had higher prices. Now you drop the 18th day, you add today's price, that number's got to come down mathematically. So I think you're going to see the market creep up in price a little bit. Whether that can last, well, I don't have the slightest idea.